Hi there everyone, good evening and welcome to The Money Show. This is the only show of its kind where we get you top financial experts to answer all your personal finance questions. I am Avan Dabash. Lots to discuss today. We'll be answering all of your mutual fund queries, and of course, there's a number that's flashing at the top and the bottom of your screen. So if you have any questions or queries, please feel free to dial in to us. Well, let's get on board. Our experts, Roongta is personal finance expert, joining in today on the show. And I like that you've brought up two very interesting topics. I'm going to start with the first one, and you talk about the behavior gap chart. Sounds very complex, but actually is very simple, which just talks about maintaining some sort of a discipline and having the right approach when it comes to investing in equities. A lot of people tend to give up very easily, saying, oh, I burnt my fingers, now it's time to get out. But there is actually an approach that one can adopt, right? And it's quite simple.
Oh, absolutely. I think while investing, most investors, while investing in equity, most investors forget that it is a long-term investment. It gives, and by long-term, I mean like 10 years. Over 10 years, I think equity is known internationally, not just in India. Internationally, it is known to give excellent returns. But whatever the market may have returned, when you look at actual investors, their return rarely matches the market return. It is normally less than the market return. And this difference between the return that the investor makes versus what the market gave, that I think is called the behavior gap that arises because of the behavior of the investor. Typically, an investor would sell when the markets are very cheap because there is a lot of fear, and he would buy when the markets are overvalued, and there is a lot of hype, uh, uh, and because of that he buys. So essentially he turns the adage of buy cheap and sell dear on its head. He actually buys dear and sells cheap. So I think uh, that is where the behavior gap comes in, and that is the reason that even though the Indian equity markets have given excellent returns, I think averaging about 15-16%, 10-year moving average of the Nifty is about 16%. Despite that, a lot of people have not made money in the market, and that is because of this behavior gap.
That's a very interesting, a point of discussion that you brought up, that really one needs to stick it out. And even in terms of dipping into the market or selling stocks out of fear when they're priced at historical lows is not the way to go about it. Well, you have any questions or queries, please dial into us. Our phone lines are open. Roongta is with us over the next half hour. First up, we have a query coming in from Mr. Narasimha Rao in email saying, I've been investing in mutual funds for the last 15 years, but I have not been making sufficient returns. Should I switch to fixed deposits? Can you please suggest some good funds that will generate returns? I think this sort of trails back to what you were just talking about, because here we have a classic investor who's saying, I've put money in mutual funds, I've not made any returns. Somewhere down the line, there has to have been some sort of an error in his approach, you think?
Yeah, so just to put some numbers on the table, he's spoken about a period of 15 years. If I look at the Nifty, 1st April 2003, and if I look at the return on 1st April 2018, he just bought the Nifty on 1st April 2003 and he held it till 1st April 2018. His return would have been close to 16% per annum. Okay. On the other hand, if he bought, say, an actively managed fund, it would have to be a veteran fund to have been around since then. But think of, say, let's say, Franklin India Blue Chip. If he had bought that, that would have given him a return of close to 21%. And to put those numbers, 16% makes 1 lakh, 10 lakhs equivalent to 94 lakhs. That's 16% per annum over 15 years. 21% on the other hand makes 10 lakhs equal to 184 lakhs. And Franklin India Blue Chip is not necessarily the highest performing fund over the 15 years. So my point is that over 15 years, not to make money in equity requires real skill, which Mr. Rao, unfortunately, like lots of other investors, has displayed. I think The only way in which Mr. Rao would not have made money over 15 years is because he sold when the markets were low. So he must have sold out during late 2008, early 2009, and he would have bought when the markets were high. Think January 2008, etc. That is the only way that you cannot make money over a 15-year period on in the equity markets.